Bismillahirrahmanirrahim. In the previous class, we discussed about working capital management. Today, we are going to start next chapter, and it is our last chapter. Chapter name is Risk and Return. First of all, we will discuss about return. That what is a return? So I'll explain this with the help of an example. Suppose you purchased a share. And the price of this share, it was $10. Now, what happened for 1 year? You kept this share with you. Now, after 1 year, the company announced dividend. I'm writing shortly. Company announced a dividend of $2, suppose. And after 1 year, the price of this share from $10, it goes up to $11. So now see, in this example, you earned money in two ways. One is dividend. That company is paying in the form of cash. And the second one, it is also your income, but it is not in the form of cash. The price of share from $10, it goes up to $11. So there is a profit of $1. So total profit or total income, it is 2 plus 1. So 2 plus 1 is equal to 3. This is basically a return. This $2, this is in the form of cash. We call it income received. Income received in the form of cash. And the second one, this $1, which is appreciation in the value of your investment, because you invested $10. You purchased this share for $10, and now the value of your investment, it goes up to $11. This is called capital gain. Capital gain. This is called capital gain. When the value of your investment, it goes up from $10 to $11, it is called capital gain. But there is also possibility that the price of share it comes down to $9 to $8. Then in that case we call it capital loss. Capital loss. So capital gain is when the price of your invested money it goes up, and capital loss is when the price of your investment it comes down. Suppose you purchased a building for $1 million, and after 2 years the value of this building goes up to $1.5 million. So this $0.5 million increase, this is capital gain. Now suppose the value of this building it comes down to $5,70,000. So the value of building comes down by 4,30,000. So this 4,30,000, this is capital loss. So return is basically the sum of income received on an investment plus any change in the market price of the investment. We call it capital gain, or simply you can say income received plus capital gain is called return. Now see the definition: income received on an investment plus any change in market price. The sum of income received on an investment plus any change in market price. And this basically we are expressing it as a percentage, as a percent of the beginning market price of the investment. And we are showing this in percentage. This. How? See? Cash flow, total return, cash flow in the form of cash, plus price at the end minus price at the beginning. So see, cash flow was $2. We received a dividend of $2. Price at the end it was $11. Price at the beginning it was $10. So it will become 2 plus 1, which is equal to 3. But we are expressing it as a percentage of the beginning price. So what are we doing? We are dividing it by the beginning price. We are comparing it with the beginning price. So divided by, what is the price at the beginning? 10. So divided by 10 divided by 10. 3 divided by 10. So 3 divided by 10, which is equal to 0.3 multiplied by 100 to convert it to percentage. So we got, so here I am writing multiplied by 100. So we will get 30%. So means our total return it is 30%. So this is the formula. Cash flow plus price at the ending price. What was the ending price? $11. Minus PB, price at the beginning. What was the beginning price of your investment? $10. Divided by PB, which was $10. So 2 plus 11 minus 10 divided by 10. So we got 30% total return. This is the formula. Now, what is risk? Different people define risk differently. Some people say that the possibility of loss is called a risk. Some people say that the chance of something unexpected happens. We call it risk. But actually, risk is the variability of returns from those that are expected. What does it mean? Suppose you invested $100,000 in some business, whatever that business is, and you are expecting that this $100,000 it will earn a 15% return every year. So this is what in the start of the business you are expecting something from the invested dollars. So this is expected return. Now at the end of year, when you calculate this, so you got what? That you earned how much? 5%. At the end of year, when you made all calculations, so you found that your actual return, it is 5%. This is called actual return. It is also called realized return. Now, what you were expecting and what is actual, there is a variability between these two. What you are expecting, the actual is different from that. This variability of actual return from expected return, this is called a risk. That what you are expecting, actual will not be like this. There will be variability, there will be change. Maybe this change will be less or this change will be more. So the variability of returns from those that are expected. Variability means the change of returns from those that are expected. The actual from those that are expected. What rate of return do you expect on your investment saving this year? He's asking a question from you. That what rate of return do you expect on your investment? If you have, suppose, some investment. So what rate of return do you expect on your investment this year? and what rate will you actually earn, and what will be your actual return. So there must be some variability. This variability, that actual will be different from the expected, that is called risk. So whenever you're starting business, sometimes your expectations are too much higher. But actually when you are starting business, so at the end when you are evaluating your business, so you're finding that what I was expecting, the actual is different from that. This is basically called risk. Then there are different sources, risk sources. The first one is interest rate risk, affects income return. Market risk, overall market effects. Inflation risk, purchasing power variability. Business risk, financial risk, liquidity risk, exchange rate risk, and country risk. We will discuss these one by one. The first one is interest rate risk. The variability in a security's return resulting from changes in the level of interest rates, referred to as interest rate risk. What does it mean? Take an example. Suppose this is 2016. You purchased a bond. I'm not talking about price bond, I'm talking about corporate bond. Face value of this bond, it is $1,000. It is paying 8% coupon. We discussed about this in the first 2 chapters, I think. And the maturity of this bond, it is 5 years. Now what happened? In 2019, suppose 2020 today, okay, leave it, 2017, what happened? Another company, they issued a bond with same face value, with same maturity of 5 years, but there is difference in the coupon. The coupon is 10%. So suppose I am giving you an option. You will purchase which bond if these two bonds are available to you. So you will check the coupon. Here the coupon is 8%, here the coupon is 10%. So you will buy this bond because the coupon is high. 10% is the coupon. So you will buy this. Suppose the person who is holding this bond, he is in need of money. He is in need of money and he wants to sell this bond. So see, you are going to purchase, you have option to purchase either this bond or this bond. So you will purchase this bond. Why? face value here is 1000, here face value is 1000, but here you are receiving 10% interest, and in this case you are receiving 8% interest. So you will not buy this bond. You will buy it when the value of this share comes down from $1,000 to, you can say, $900. If it will come down, then you will buy this bond. Otherwise, you will not buy this bond. So because of this bond, because of increase in the interest rate of this bond, the value of this bond comes down. 900, or maybe it comes down to 800. There will be calculation, we will calculate it, then we will say that we can sell it for this value. So see here, increase in the interest rate. Due to increase in the interest rate, the value of other bonds in the market, it will come down. This is called interest rate risk. If interest rate increases, see, from 8% it goes up to 10%. So when interest rate increases, bond prices decreases. This bond, the value of this bond, it will come down from 1000. Now you can sell it for 800. Otherwise, nobody will purchase it. So if interest rate will increase, bond prices will decrease, and vice versa. If interest rate decrease, suppose interest rate, it was 8%, it comes down to 6%. Now if it comes down to 6%, the demand of this bond will go up. Why? 1000 is face value, 1000 is face value. Here interest is 6%, here interest is 8%. So people will prefer this bond because interest rate is high. So because of decrease in interest rate, the value of this bond, it will go up. Now it will be sold above 1000. Maybe 1100, maybe 1200, maybe 1150, whatever. So if interest rate increases, bond price decreases, and if interest rate decreases, bond price will increase. Previously interest was 8%, now it becomes 10%. When it becomes 10%, so the value of this bond, it will come down. Now nobody will purchase it for 1000. If you want to sell it, you will sell it at discount. We call it discount, or below $1000. But take the second case. 8% was interest. Now next year the bonds which are issued, interest rate is 6%. In this case, now the value of this bond will go up. If interest rate decreases, the value of this bond, it will go up. It will be sold at premium. This is basically called interest rate risk. The variability in a security's return resulting from changes in the level of interest rates. If interest rate changes, the value of securities, it will be affected, and it is referred to as interest rate risk. For example, when the interest rate increases, the bond price decreases and vice versa. I explained this thing in the example. This is basically called interest rate risk. The second source is market risk. Market, overall market. The variability in returns resulting from fluctuations in overall market. It is the risk which is affecting the overall market, like recession. Economy is coming down. In economics, you people study recession. Economy from boom, it is coming down. So we call it recession. When there is a recession, the profits of all companies will be affected. If there is war, the profits of all companies will be affected. If there is structural changes in the economy and changes in the consumer preferences, if consumer taste is changing, or there is change in the economy, structural changes in the economy, recession, depression, so it will affect the whole market. It will not affect only one company. It will affect the overall market. So this type of risk which affects the overall market, all the companies in the market, it is not affecting one company, or it is not affecting two companies. It is affecting all the companies in the market. This type of risk is called market risk. So the variability in returns resulting from fluctuations in overall market. So there is variability in return, and that variability is because of the fluctuations in overall market. Like nowadays, the economy of Afghanistan is down. So it is affecting all the businesses. It is affecting all the companies. Recession, the economy. If economy is coming from peak, this is the peak of the economy, this one. But when economy is coming down from peak, this is called recession. So from peak, economy is coming down. This is called recession. So recession will affect all the companies. If there is war will affect all the companies. Structural changes in the economy. If there is changes in the economy, structural changes in the economy, it will affect all the companies. If consumer preferences are changing, so it will affect all the companies. It will not affect only one company or two companies. So this is market risk. The next one is inflation risk. We will discuss it in the next class. So today we discussed about the definition of return, that what is return. Then after that we discussed about the definition of risk, that what is risk. Then after that we discussed about two sources of risk. The first one was interest rate risk, and the second one was market risk. Inshallah, in the next class, then we will talk about inflation risk, business risk, financial risk, liquidity risk, exchange rate risk, and country risk. Okay, have a good time. Assalamu alaikum.